Welcome back everyone. In this video I will present a case study on MC4 as a whole system. We will study the price movements along with the monetary movements of options and futures. We will also examine the related operational triggers that I believe significant. Therefore, in this video we will observe the movements of price and money on the American market, both during the Great Rise and the subsequent incredible collapse that happened during the period from October 2019 to June 2020. The Great Rise in S&P, which started in the first days of October 2019, took place according to the speculation and hedging methods that we have learned in the MC4 model. The long trading range between 2,800 and 3,000 lasted many weeks. It developed within the indifference area of the distribution between the limit areas VI plus 40 and VI minus 40. Precisely in the lower part there were more than 35% of puts and in the upper part more than 35% of calls. The market has been a benefit for day traders and for most swing trading systems. The futures open interest remained unchanged. The open interest of the options increased only on the OTM strikes on both the call and put sides. During the small corrections the put side increased and during the small rises the call side increased. Suddenly, the market broke the limit, the 3,000 area was crushed and prices consolidated on the upside. This was a very important area where over 40% of the call options persisted. This considerable amount of sold calls were in danger, so the operators were forced to enter the market with long futures in order to cover the so many calls that were becoming ITM. In fact, from 18 October we witnessed a first sharp increase in the open interest of the future. For the entire period from October 2019 to the first days of February 2020, which coincide with the maximum of the prices, the market has always responded daily, with an increase in puts below the price, an increase in futures, and rolls of calls. The entire long phase of the uptrend was accompanied by the same monetary movements that, from week to week, modified and rebalanced the portfolios of operators. The risk was kept to the put side, leaving more and more room for the market to move up. The ratio of total puts to total calls has gone above the 1.99 level. Then, from February 17, 2020, we began to witness a first weakening of the trend. The underlying price was striking new period highs. The implied volatility was reaching record lows. The open interest of futures, that was recording highs, started to fall. This distribution machine took place on the VI plus 70 and lasted for many days. Every day the market signed a new price high, which however corresponded to a significant decrease in the open interest of futures, a rollover of call positions and adjustments of the put side. At some point the futures were completely downloaded. After the Black Monday of February 24, the market changed its face, and for many days we witnessed a continuous increase in the futures open interest. The operations were hedging the put side that had been in danger. In the options market we saw a rapid retreat of sentiment, with the closure, more or less on all strikes, of the put side. Volatility exploded and prices sank rapidly in few weeks under the weight of bearish futures contracts that have reached their all-time high record of open interest. Then, only after the bottom of March 23, where prices reached the lows of the period, coming close to 80% ITM puts, we witnessed the first important easing of the futures open interest. For many days, when the underlying price rebounded, the futures contracts decreased remarkably. Adjustments were performed and new puts and calls contracts were added to the market. Subsequently, the prices slowly returned to the new indifference area and remained in the trading range for many days. Volatility decreased, futures open interest returned stable, and the options market begun to revise the classic call and put positions on the sides of the ATM. Until 22 May there have been attempts to break, both downwards and upwards, this area of congestion between 2750 and 2950, in line with the new values of the distribution of open interest. But it was only after May 26 that the real upward break occurred, and it was confirmed by the sharp increase in the futures open interest, by the new put contracts to support the price, and by the closure and rolls of the calls at higher strikes. This led to a huge upward rebound movement as soon as the prices broke through the important barrier of 40% calls. Thank you for your attention, I hope you enjoyed it. If you wish, I am waiting for you in the operational section of the MC4 model, where we will learn what strategies to build at critical market levels and the related adjustments and corrections. See you soon.